So, given the market conditions right now in September of 2025, I thought it might be a good time to check in to see what might be some good strategic investments at this moment. So, just to recap this year, I think we've continued to see explosive growth in AI. Obviously, it's been a bit bumpier than what we've seen in the past. There have been ups and downs, but seemingly a lot of the super big mega cap stocks have done really well this year. Year to date, if we look across the board, whereas like a few months ago, mid cap and small cap had been outperforming large cap stocks, at this point, large cap has now started to outperform for the year. That said, we're seeing a lot of continued high valuations for the S&P 500 and for these huge companies. So again, it's a question of whether we're going to see AI actually save people and companies money enough to justify the expenditures that they're taking on right now. We're seeing a lot of the growth in artificial intelligence is simply due to people pumping money into it, right? So you have a lot of companies that are projecting huge AI savings. Oracle came out and said that they were going to see huge growth in that area, and their stock, went up about 40 something percent in a single day. But that doesn't necessarily mean that it's going to come true. So, I thought I would simply sort of outline where my head is at, continuing to create a diversified portfolio, but to use passive ETFs to create tactical moves at the same time. And so I'm going to outline ETFs that I think could be good additions to your portfolio at this moment as we go into the rest of the year. Again, momentum is strong and it seems like AI won't continue, but that's all contingent on there being some actualization of the benefits of AI. So any sort of negative news that might come out, whether that's, some research report that says that cost cutting savings aren't going to be as much as we think, or whether implementation is much slower or maybe not as promising as we once maybe had expected, that could really, cut down the valuations of these huge tech companies, which would still leave them, fairly valued or even still overvalued because they are so aggressively valued at the moment. Just for context, the S&P 500's PE ratio is 27.6 right now. So that's fairly high for, these companies. Obviously, like, again, I've said this in a previous video, a huge portion of the S&P 500, something like 40%, is concentrated in just a few stocks, so about 10 stocks. So, when you're talking about the S&P 500, it's kind of a misnomer at this point because, it's not really spread across 500 companies equally. It's really concentrated in these top mega cap stocks. So again, just with that context, I would say I'm looking for where there are relative fair valuations and where we might see some outperformance when it comes to the following few months. The first place I'm looking is some component of the S&P 500, but more value oriented. And so this can come in lots of different forms. It could be a large cap value ETF. It could be a sector that tends to have more valuations. But for me, I'm going to narrow in on VYM, which is Vanguard's high dividend yield ETF. And so high dividend yielding stocks are generally going to be consistently highly valued companies that pay dividends over time. So this means that they're going to experience less high growth, but they'll still pay out high dividends. And this just means that you're going to be looking at more large cap value stocks. If we look at the holdings, the sort of top holdings of VYM, you're looking at pretty conventional names, right? You're looking at Broadcom, JP Morgan Chase, ExxonMobil, Johnson & Johnson, Walmart, Home Depot. These are companies that are likely not to grow as fast as something like Nvidia or even Microsoft at this point, which could benefit hugely from AI, but will not lose value on any negative reportings of AI, right? Because they're really not, their valuation isn't contingent on AI being a huge play in their growth, and they're going to continue to pay high dividends. So again, this is a value play. So I would say one segment is just looking for large cap value, a place that pays high dividends. So you're getting consistent income. You're going to sacrifice less growth if there is continued momentum, but you're going to be seeing more steady returns. A bunch of people are a little bit skeptical of the continued growth that's happened in the market, and people are basically saying like they're expecting lower returns from equities over the next 10 years on the whole. So if we're expecting lower returns, that probably means that we're going to have some negative years. And so as much as we can organize our portfolio in such a way that we can limit the downside, I think is always good. Sticking with this value-oriented mindset, one sector ETF that I would consider is Vanguard's Consumer Staples ETF, which is VDC. And VDC contains holdings that, again, you're going to be very familiar with, and there's some overlap, right? So it's Walmart, Costco, Procter & Gamble, Coca-Cola, Philip Morris, PepsiCo. So these are, again, when you say consumer staples, they're things that consumers are buying all the time. It's not dependent on whether it's a good economy or a bad economy. These are things that people will need to buy all the time. So it's food, things that they need to live their everyday lives. Again, this is a value-oriented play. It's also a play on the economy shifting downward. Obviously, inflation is ticked up. Jobs are not as robust as they once were. And, valuations are slightly lower than the overall S&P 500 at 24.6x. But, on the whole, we're really looking at downside protection here. So if there is any sort of recession or people begin to pull back their discretionary spending, our consumer staples will just withstand any volatility more. So again, this is a value-oriented play and a downside protection play. Our next two ETFs that I want to talk about sort of lie in where I can see there being growth, but there hasn't been as much growth because of AI. And so the first ETF that I would consider is VFH, which is the Vanguard's Financials ETF. And the reason I'm including this is that financials will do very well in a deregulated environment. I think regardless of how you feel about the political environment, the big banks have a lot of sway with legislation and with lobbying, and they're the types of players that are in constant contact with the administration. So they're going to be pushing deregulation. And on top of that, it's a very information-based sector. So they're actually really ready for the implementation of AI. When you don't have jobs that require manual labor or that is offline, you can really quickly integrate artificial intelligence into your systems. Obviously, this takes a longer time with big companies, but when we're talking about information trading, which is all financials are, you're optimizing with information. And so if you can do that very quickly, you can very quickly reduce costs, increase your revenues. And on the whole, the financial sector right now is undervalued compared to the S&P 500 with a P/E ratio of just a little over 18. So it's significantly cheaper than a lot of the S&P 500. Again, the S&P 500 is being driven up their valuations by these big tech stocks. But on the whole, if you're just buying into a passive ETF, the financial sector is a lot cheaper than the S&P 500 as a whole. And these are, your typical financial institutions as well, which you'll see in the top holdings: JP Morgan, Berkshire Hathaway, MasterCard, Visa, Bank of America, Wells Fargo, Goldman Sachs. These are companies that earn money based on holding your money and lending that money out. As credit eases, there's going to be a lot more lending that happens. People are going to be borrowing more money as interest rates fall. And so this can be an environment for these financials to do very well. In a similar way, but that it benefits on the rise of AI, but sort of a different play, I'm looking at the Vanguard's Utilities ETF, VPU. So this play really is, again, it's a value play because it's slightly lower as far as valuations go. The PE is just 21. And it's also a play on the fact that AI is so energy intensive that they're going to need an enormous amount of energy to power it. So we're talking about these huge energy companies that are going to be supplying all the server farms, all of the computing power. This is highly energy intensive, and they're going to be buying up this power from these companies. So you might not have heard of all these; they might not be household names, but they're supplying a ton of energy overall, and obviously to this increase in AI. And that's Nextera Energy, Southern Company, Constellation Energy, Duke Energy, Vistra Energy. The play is really just that energy consumption is going to go up a ton, and these energy companies will benefit from that. Lastly, I would argue that we still need to diversify across regions. So I would say that, you can pick whether you want to choose. Vanguard has a Pacific fund, a European fund, an emerging markets fund. But on the whole, I think exposure to markets outside of the US is good right now, only because the US has experienced the majority of the growth to date in the last 10 years, that those other markets are really ripe to have a rotation into performance. So the ETF that I would maybe suggest is VEA, which is Vanguard's developed markets ETF. And this is going to also be just like really big companies as well, because they have ASML Holdings as their #1 stock, SAP, which is also sort of like a competitor to Oracle, an information technology company, AstraZeneca. We have some healthcare stocks, Nestle, Novartis, Samsung. So these are names that you've probably heard of. They're working internationally. They're not just focused in their region of origin. They're selling abroad to the world. But this really helps diversify your portfolio and will help also alleviate any of these sort of downturns to your portfolio with regards to tariffs and any political climates. Just from this year, we've seen major volatility just because of announcements of tariffs and what's happening. And so having stocks that don't rely on any particular political climate, especially within the United States, would be helpful in just diversifying your portfolio. So while there are more ETFs that I might consider adding right now, those are sort of a broad range of ETFs that I would add at the moment, going into the latter half of the year. I would say that on the whole, I'm looking for more value-oriented stocks. I'm looking for stocks that can benefit from AI, but haven't been driven up by AI already. So not the first sort of tier of chip makers or tech companies, but ancillary industries that will be needed to help power AI. And then looking abroad, because we've seen the US grow so explosively over the last 10 years, mostly focused in tech, that we want to see some coverage with regional stocks. So that's just where my head's at right now. I think that overall, we will probably see some continued momentum in AI, but we never know when that's going to pull back. So to be prepared for that will help your portfolio withstand any downturns.